Having a lot of debt does not feel good, but it's even worse for your personal credit. In this video, I'm going to walk you through exactly how you can actually bring down the balances on your personal credit cards so you can actually qualify for new loans such as buying a car or buying a home. You can actually save a lot of money on interest, and you can qualify for some business funding if you're looking to grow your business and make a lot more money. So your utilization ratio is one of the most important ratios when it comes to your actual personal credit because it makes up 30% of your credit score. And so this utilization is actually most important for your personal credit cards. It is not affected by loans, mortgages, or anything else. It's really how much of your personal credit cards are you using. So the banks allow you to spend a certain amount based on your credit limits, but although they allow you to spend this amount, they really don't want you to keep that much money on there. So the goal is to bring your utilization down to below 30% at least so you can actually qualify for new lending options, and below 10% if you want to maximize your results. But overall, you want to bring your utilization down below 30%. So let's say, for example, you have a credit card that has a $1,000 limit. If you're carrying every single month $900, you're at 90% utilization, which is really high to the banks. So this could potentially drop your score about 60 to 80 points, just 1 month to the next, so very, very quickly. But once you bring your score or your utilization down to below 30%, your score is going to instantly come back up. So that's the great thing about utilization, however, is that it does change very quickly against you, but also for you as well. So I have a couple of different options when it comes to the personal side of things. So whenever you're actually looking to bring down your utilization, the metric really only matters for personal credit cards. So I typically recommend getting personal loans so you can actually qualify to get some money in the bank to then pay down the credit cards. So this will allow you to, again, bring down the utilization ratio and bring your score back up. And that's because the loans do not affect that metric. So it's completely separate. Even if you're carrying a balance on auto loans, personal loans, mortgages, it does not affect your utilization ratio. So that's the first part that we're going to dive into. And then the second part is actually qualifying for some business funding, because all the debt that you carry on your business does not reflect on your personal credit. So if you were to have some business funding, you could potentially transfer over some of the debt from your personal over to your business so you can actually really help your personal credit. So I'm going to show you all kinds of different examples here, and we can dive right in. So the first recommendation I would make is actually going to whatever bank you're currently banking with. So if you have a personal checking account with Wells Fargo, that's where you get all your different pay stubs. That's where you actually make all your transactions. They know you, they see your history and your behavior, and banks typically like to work with people they're already working with. So they already have a relationship with you, and they'll be a lot more open to continuing, basically. So I would recommend checking out whatever bank you're currently banking with on the personal side. So this would allow you to most likely get approved a lot easier, and this will apply for all the major banks. So if you're currently banking with Wells Fargo, Chase, Bank of America, most of them have personal loans as well. So we can see right here, personal loans. Okay, so they're gonna have a couple different options most likely, but you should be able to find some pretty good offers, and this would allow you to, again, bring your utilization down. So my first option typically is going for wherever you're banking right now. It should be a lot easier for you to actually get approved. So we're gonna go through different options here, and it's actually by order of preference. So number one is your personal bank. Number two is going for some kind of fintech online-based lender. So some of my favorite ones are SoFi and then also Lending Club as of lately. So these are also great options because SoFi has a lot of different loan options as of the personal loan as well. But the great thing about these fintech companies is that they actually allow you to apply as a soft pull and then potentially get that pre-approval. So what this means is that you can apply without hurting your credit. So a soft pull is very different from a hard pull. A hard pull is when the bureaus get a more in-depth view of your credit. It'll show as an inquiry on your report. And if you have too many inquiries on your report, it actually hurts you. So I wouldn't really worry about having one extra inquiry on your report. But if you have too many of them, eventually you basically get blocked off. So whenever you're applying for a new personal credit card or business credit card, for example, if you have more than 3 inquiries on any one bureau and the bank tries to pull your credit on that bureau, it's basically an automatic denial. So ideally, you want to keep your inquiries as low as possible, limit applications that would cause a hard inquiry unless you're really needing the account, basically. So in this case, you're actually able to apply as a soft pull. So you could apply, see how it goes. If you get denied, well, no harm done. But if you get approved, they would, in this case, actually do a hard pull, but you know it's worth it, basically. So that's the benefit right here. And also another benefit is that if you apply, you get that soft pull and you get denied, well, it's very easy to actually reapply in the future. So you could potentially apply for this maybe every 2 weeks, enter different data points on the application and see if it goes through. So these are great options right here. So I really like SoFi. I've been using them for a while. I've been hearing a lot of great things about Lending Club as well, so I'd potentially check them out. And so they have a lot of different options as far as personal loans go for both companies here, so I would definitely check them out. And then the next option would be going to a local credit union. So I live here in South Florida, and so one of our local credit unions is We Florida, or We Florida Financial. So credit unions are a lot different from major banks such as Chase, Bank of America, in which they don't have that big national brand. So they're a little bit less known, and they have to make up for that to attract clients. So to make up for that is by giving really great lending options. So typically, if you were to get approved for a loan, it'll typically be for lower interest rates. So I know for me, whenever I'm applying for a new car loan or all my clients, I usually recommend going to a credit union because you'll get the best rate for auto loans, but also potentially for mortgages, but also for personal loans. So this is a great example right here for We Florida Financial. You can also see that they have different loan options as well. So to give you a rundown of what these actually mean, a secured personal loan means that you're basically putting money down and then borrowing against that money. So if you're actually going through the strategy, you probably don't have any money to put down. So that's why we're going to focus on the other ones here. Personal lines of credit, I wouldn't necessarily maybe use this right now just because they're great because you can pay them down and use them again. But these are going to be even higher interest rate, and it's not really what we're using this for right now. But the unsecured personal loan is a great option because you don't have to put any money down. It's just based on your credit. So this will be a great option for you. We'll just focus on the unsecured personal loans. I would apply that to all the previous lenders as well. So this is typically going to be potentially the easiest one to apply for. And then we have Lightstream. So Lightstream is a great option because you could qualify for larger amounts than most personal loans. However, they're going to be higher interest rate than the others. So Lightstream is great because they have the option for an unsecured auto loan. So this would basically allow you to qualify for what would be used for an auto loan, but use it as a personal loan. So the benefit here is that you can qualify for loans typically up to $40,000, and they usually don't really check what you actually use the loan for, which is great. So if you're looking to actually qualify for a lower amount, somewhere around the $20,000 or less, you can focus on all the other lenders because you'll probably get a better deal. But if you need something around the 20 to 40 range, you might have to go for Lightstream. But Lightstream is a great option just because they're somewhat easy to qualify for. And again, you can qualify for these larger amounts. They are, however, owned under the US Bank umbrella. So if you have any type of problems or issues, such as bad payment history with US Bank, you probably won't get approved though. So something to pay attention to. But they're a great option. So you just go to Lightstream, auto loan, and then just navigate through that. But these are all really great options right here. I would check out all these different lenders and see what would make the most sense for you. But when it comes to the actual filling out the applications, I'm going to give you a couple nuggets right here. So some application tips. Most of the time, it's going to be easier for you to get approved for lower amounts when it comes to personal loans. The higher the dollar amount, the riskier it is for the bank, and the less likely you are to get approved, just because all these loans are unsecured. So basically, if you don't pay them back, now they have to come after you. They don't have anything backing the loan, such as a car loan. They can just repo your car, right? But these loans, they don't have anything backing it necessarily, so they have higher risk. So that's why you don't want to go for too much of a loan, especially because, again, these are a little bit higher interest rate as well. So I wouldn't really go above and beyond. Just apply for what you actually need to get your utilization to below 30%. If it's not a whole lot, maybe even go for under 10, but just get under 30%, only what you need. That's what I recommend right here. So keep it under $25,000 ideally for the other lender. But if it is over $25,000 and you need less than 40, you could potentially get approved for Lightstream, which would be a good option for you. But when it comes to the actual purpose of the loan, I would recommend actually selecting home improvement. This tends to get the best approval odds for whatever reason. So just tell them that you're actually using this to renovate your kitchen or whatever. So this gets much better results than just saying credit card consolidating. So I would recommend filling out your loan application for home improvements. When it comes to the actual income, ideally, the higher the income, the better, just because it shows that you have a better ability to actually pay back the loan. So if your income is currently under 100,000, I would say all the way up to 100, just because usually they have so many applications every day. There are certain brackets in which they're just gonna have so many, they're not gonna be able to check all of them. So typically $100,000 is that level in which 100 and below, they're usually very rarely going to check that number. So if you're currently making less than $100,000, I would just put 100 so that you have better chances of approval. If you do, however, make over $100,000 and you can prove it, then put in whatever amount that is. And then when it comes to your actual employment, I know that I have a business page right here, so you're most likely running a business. If you're not, that's also fine. But if you are currently anything other than employed, you want to say you're employed. So if you are running a business, you just say that you're employed by your business. And you'll see that when it comes to personal loans or really any type of lending application, it's so much better to say employed just because it seems a lot more stable with a regular income. And although we know that business is nothing very consistent about business, but if you say employed, you'll get much better results than saying self-employed. So I'd recommend on your application, keeping it under 25,000, up to 40,000, I would say for Lightstream. You would input the loan purpose as home improvement. Higher the income, the better. If you're making under 100K, put 100K. If you're over and you can prove it, whatever dollar amounts, then you want to fill out as employed. So that's basically how you bring down your utilization by qualifying for a personal loan. This will not affect your utilization number because it's a different type of debt product, but your utilization makes up 30% of your credit score. So if you can fix this, your score is going to instantly shoot up. So this is what you can do on the personal side of things. But let's say right now you have an LLC and you want to potentially move some debt over to your business. The huge advantage here is that the whole lending that you have on your business does not show on your personal credit. So if you were to have $100,000 of business funding and you had everything maxed out, well, it wouldn't actually drop your personal credit score by 1 point. So that's the beautiful thing about business funding. If you have a really strong foundation, you qualify for a lot of funding, but still keep your credit clean. So in this case, you could potentially qualify for some funding and then move some debt over to your business. It will, however, be hard for you to get approved if you have high utilization though, even on the personal side. So that high utilization on the personal credit will affect your business funding, but high utilization on the business doesn't affect your personal or even future business funding applications. But the way to actually get through this would be to potentially build up your business credit profile and then qualify for one of these easier lending options. So there are some companies that allow you to qualify for funding based on transactions. So if you currently have some transactions in your business coming through and you're making a little bit of money, the companies would actually lend to you based on that. So there are companies like Square, Stripe, QuickBooks, Cabbage as well with a K. So all these companies allow you to process payments through them, and they make their little fees, that 2.9% or so. So they make a lot of money from their clients. And if you bring over business, they sometimes also allow you to borrow based on your transaction volume as well. So if you have about 3 months of transactions and the lender feels comfortable lending you money, they would potentially offer it to you. But after 3 months, you can also ask for it if they haven't. But these rates are also usually not that great. But again, the goal here is to really just bring your utilization down temporarily so that you could potentially just fix your situation and then get some better lending options. So if you were wanting to get something that wasn't on the business side of things, you could potentially get a personal credit card that was a balance transfer card. So now you could move some credit onto that card, potentially even out your utilization ratio and have some 0%. Even better would be to have an LLC, and once you fix your utilization percentage on the personal, you could then qualify for some business funding, and then you could either balance transfer over some debt onto that card or liquidate the card and then have some cash in the bank to just pay some stuff off. So really, the different options in this video allow you to free up your utilization so you can then qualify for better lending options. And I think the best lending option will be qualifying for some business funding that you can then use to basically pay everything down, move it over to your business, and fix your personal credit. So that's basically the whole gist here of this video. Hopefully that gives you some ideas. If you have any questions about this entire process, just drop some questions down below. We also have a free program that actually goes in depth onto this entire process of optimizing your personal credit, starting up your business, getting some funding. So if you want to actually join our program, there's a link down below here in the description. But overall, I appreciate you for watching these videos and be a part of this journey here. If you want to follow for some more tips on your business and on actually growing your business, just be sure to subscribe to this channel, and I'll see you very soon.